Welcome to this presentation on financial ratio analysis. Financial ratio analysis, it is a quantitative method of gaining insight into a company's various operational and financial performance by calculating the ratio of two items taken from the financial statements. We'll be covering the following areas in this presentation: objectives of financial ratio analysis, the various kinds of financial ratio analysis based on purpose and the areas in which they provide information, liquidity ratio, profitability ratio, leverage ratios, efficiency ratios, market ratios, coverage ratios. Examples of ratio analysis: the Dupont analysis, how different ratios are used by different purpose, how different ratios are used by different persons for different purpose. I'm Aninda Datta, the presenter. Now, what are the objectives of financial ratio analysis? It is the interpretation and analysis of the financial statements. Financial statements of a company could be broadly analyzed by the following methods. Horizontal analysis. This covers comparison of companies' financial data with previous year's data captured into various heads of financial statements. Example, trend line of actual sales over the past 5 years. Vertical analysis. This covers comparing of the same period's financial data captured under various heads of financial statements with a reference value. Example, ratio of various expenses to sales. Financial ratio analysis. This is another method of financial statement analysis that allows comparison between two companies, two different industries, or performance of the same company over different periods. Financial ratio analysis also serves as a very good tool for decision making by the managers and investors. Financial ratios offers the scope to increase the granularity of ratio analysis by decomposing one ratio into more than one ratios. For example, suppose the net profit ratio, that is the net profit by sales, shows year-on-year decline. Then to pinpoint the reason, this ratio could be split into two by dividing both numerator and denominator by EBITDA, that is earning before interest, tax, depreciation and amortization. So the new net profit ratio or the new profit ratio could be restated as such, as following, that is net profit by EBITDA into EBITDA by sales. So this will show a more granular picture. These two ratios could be further split up to get a more micro level insight. Now, what is liquidity ratio? It measures a company's ability to pay short-term debt as they become due. Liquidity ratio. This ratio takes both numerator and denominator from the balance sheet. It comprises the following ratios. Current ratio. Ratio of current assets by current liabilities. All figures are taken from the balance sheet. Now, current assets comprises the following: inventory, accounts receivables, market securities and cash. Current liabilities comprises accounts payable and short-term debts. A high assets value indicates the company selling goods by extending credit. The inventory is slow moving. A high current liability indicates the company is buying on credit. A low current ratio indicates better liquidity position of the company. The quick ratio. It excludes inventory from the current assets for a more stringent liquidity assessment. This shows the company's ability to pay off the creditors without resorting to panic selling of inventory. Cash ratio. The most conservative liquidity ratio covers the company's cash and cash equivalent to cover short-term debt obligation like paying off working capital loan. Now, what are profitability ratios? Profitability ratios indicate how well a company can generate profit from operations. Gross margin ratio. Gross margin ratio indicates a company's ability to earn profit from core operations, that is sales price minus cost of goods sold, COGS. High gross margin ratio indicates high pricing power or high capital intensive businesses having high depreciation and high interest cost. Here both numerator and denominator are taken from the profit and loss statement. Proprietary products like pharmaceuticals, higher-end brands, etc. have high gross margin. Capital-intensive industries like cement, steel have high gross margin to cover for high interest and depreciation expenses. Now, net profit ratio. Net profit margin indicates net profit after accounting for all expenses of the year. It is given by gross margin minus depreciation minus interest minus all other write-offs minus income tax. Here both numerator and denominator are taken from profit and loss. High net worth ratio indicates high profitability of the company before comparing with the capital invested. Companies with high pricing power like FMCG software have high net profit ratio. Some capital intensive industries like gas distribution, oil companies also have high net profit ratio, but those generally score mediocre marks in return on capital ratios. Return on equity ratio. Net profit divided by shareholders' equity on net worth, so this is the final profitability matrix. If total capital replaces equity capital, it gives return on all capital invested, that is return on invested capital. Here numerator comes from profit and loss statement and denominator comes from balance sheet. Companies having high return on equity are truly profitable companies, and these companies provide very good shareholder returns over long term. High return on equity is maintained by companies operating in industries having high entry barriers like strong technical know-how, access to raw materials, strong brand pool of consumer products. Examples are leading software companies, leading consumer-facing companies, specialized machine builders. Positive cash flow from operations is the biggest indicator of profitability, as innovative accounting cannot change the cash inflow figure. Now, what are efficiency ratios? An efficiency ratio measures a company's ability to use assets to generate income. Inventory turnover ratio. This is calculated by the formula sales divided by the average inventory. One profit and loss figure and one balance sheet figure. A high inventory turnover ratio indicates a low working capital cycle, that is capital is not blocked in inventory for long. The companies with high SKU range for unit sales have low inventory turnover like home appliance, faucets, vehicles, etc. This ratio is important for production planning, so intensively monitored by company managers, and ratios are calculated for every product group. Asset turnover ratio. This is calculated by dividing sales by average fixed assets, one profit and loss statement figure and one balance sheet figure. A low asset turnover ratio is present in high capital intensive industries and vice versa. Low capital intensive industries like FMCG software have high asset turnover ratio, whereas an oil refinery has low asset turnover ratio. This ratio is monitored by both managers and investors, as high asset turnover ratio is important to achieve a high return on equity. Now, accounts receivable turnover. This is calculated by dividing sales by average accounts receivables, one profit and loss figure and the other balance sheet figure. A high accounts receivable ratio indicates efficiency of company's credit collection department and high market pull of its products. A company saddled with large inventory at the distribution channel, that is low market pull of its products, has low accounts receivable ratio. This ratio is monitored by the internal managers to gauge secondary and end consumer sale of its products. Now, what are leverage ratios? Measures a company's inherent financial risk by quantifying the reliance on debt to fund operations and asset purchases. Debt equity ratio compares company's total debt to total equity, indicating financial leverage. Here equity means equity capital plus reserves, so both numerator and denominator are from the balance sheet. Companies may prefer debt for long-term capital needs because debt is cheaper, as interest payment enjoys income tax deduction. However, the risk of high debt to equity ratio is the company may default on repayment and interest obligations during the downturn or during interest rate hikes. Interest coverage ratio measures a company's ability to pay interest expenses on outstanding debt. The numerator is EBIT, earning before interest and tax. Denominator is the total interest burden, both taken from profit and loss statement. Companies with lower debt to equity ratio enjoys higher interest coverage ratios, who have less risk of default during hard times. Generally, less capital intensive industries like FMCG, IT, consulting enjoy high interest rate coverage. Asset to equity ratio provides insight into how a company finances its assets through debt or equity. The numerator is a net value of total assets. Denominator is total net worth of the company, both balance sheet items. If the return on equity, return on invested capital is more than the cost of debt, then many companies use debt to buy assets, as that increases the return on equity. As quantitative easing is in developed world pushed down interest rate to unrealistic levels, asset to equity ratio of many companies shot up. Now, what are market ratios? These ratios are used by investors to do fundamental analysis of the company. Price to earning ratio. The market price of a share divided by earning per share. EPS is net profit divided by total number of outstanding shares. P ratio indicates how expensive is the company's share, that is, how many years would be needed by the company to earn the current market price. Generally, high P ratio is observed in high growth industries, as investors are paying premium for future growth. The matured industries show lower P values for its shares. During bull market, the overall P multiples of the industry increases. The reciprocal of P gives earnings yield, which is generally higher than the policy interest rate, to reflect the equity risk premium. Now, dividend yield. The dividend per share divided by market price per share in percentage terms. Here, only dividend on equity shares is considered and not dividend on preference shares. The dividend yield acts as a powerful tool to attract investors and creates a floor price for the share. The dividend yield is generally high for less capital intensive industries and matured industries, as those do not need much capital reinvestment into the business. The dividend yield is benchmarked against the yield on investment grade bonds for investments by institutions like pension funds, universities, etc. These investors invest in companies having dividend yield above the bond yield. Now, market to book value ratio. This ratio measures the market price to book value per equity share, which is calculated by dividing the net worth of the company by number of shares. The companies having large intangible assets like intellectual properties or brands generally quote at high price to book value, as those companies do not rely much on physical assets and generate high return on capital. Companies relying on physical assets and capital intensive by nature generally quote at low price to book value. The companies engaged in industries like steel, petrochemicals, airlines quote at low price to book value. These companies engaged in knowledge-driven industries like software, consulting, or even FMCGs quote at high price to book value. Now, what is Dupont analysis? Dupont analysis is a method of ratio analysis whereby the financial ratios are decomposed into many hierarchical levels to get granular insights into working of a company. The most important profitability indicator of a company is the return on equity, given by the following formula: net profit by equity capital plus reserves for distribution. Now, let's multiply both numerator and denominator by the revenue. So we get the following result. The net profit by equity capital could be restated as net profit by revenue into revenue by equity capital, which is return on equity is equal to net profit margin into equity capital turnover. Now let's multiply both numerator and denominator of the above equation by assets. So we get the following equation. Net profit by equity capital equal to net profit by revenue into revenue by assets into assets by equity capital. That is, return on equity becomes equal to net profit margin, asset turnover, and the leverage factor. This way we can decompose every ratio to add one more hierarchy and enhance the insight of information for better comparison of financial data between the companies. However, the detailed and complete Dupont analysis would be done in the next video. Now, what are the limitations of financial ratio analysis? The financial ratios are as good as the data that goes into their calculation. So if garbage data goes into accounting process, then ratios also throw up wrong figures. The companies in different countries follow different accounting standards, and companies within the same country may follow different accounting policies within the framework of the accounting standards. Thus, comparing performance of different companies through ratios is not exactly orange to orange comparison always. The same company may follow different accounting policies during different periods, thus reducing the effectiveness of ratios in multi-year comparison. The details of Dupont analysis and the further decomposition of ratios to do more granular comparison would be covered in the next video. So this concludes its presentation. Thanks for watching.